Welcome to the Phil Tracy Money Audio Commentary. This is Owen Tracy recording, and it is 3:46 p.m. That is Central Time. Today is January 10th. Today being Friday, it's the big picture, long-term audio and video for the various different asset classes. I'm kicking off with the 2-year yield. It's up 11.5 basis points today. So what we can certainly see here is the long-term trend. And I think we should be looking at this in perspective. And I thought that what Howard Marks had to say in one of his memos this week was particularly influential in terms of what the market picture is looking like at present. And I'd like to read it to you to begin. It's the price of the S&P 500 has averaged roughly 16 times earnings in the post-World War II period. This is typically described as meaning you're paying for 16 years of earnings. It actually is more than that, though, because the process of discounting makes $1 of profit in the future worth less than $1 today. The current value of a company is the discounted present value of its future earnings. So a PE ratio of 16 means you're paying for more than 20 years of earnings. And of course, that is depending on the interest rate at which those future earnings are discounted. Well, when we look at the 2-year yield, there are two reasons for looking at it. One is that people like Jeff Gundlach, and we can see really empirical evidence of this contention, is that it's the best lead indicator of where the Fed funds rate is likely to go. And it has bounced in a material fashion over the last 3 months, which implies that the risk of interest rates rising in 2025 cannot be ignored. And in fact, if we're simply to look at the 2-year yield, it's probably more like the base case. But then let's also look at the long-term trend downwards from the peak in 1981 all the way down to the lows in 2020. So that was something that was flattering valuations. When we think about what Howard Marks has to say about the impact of the interest rate environment on the perception of what the valuation is, if the discounted rate at which those valuations are being looked at continues to contract, then it makes the valuation look better. So over the long swathe of time between 1981 and 2020, 40 years, every time it looked like valuations were looking a little bit overzealous, then interest rates continued to contract, and that made them look a little bit better. Whereas what we're seeing right now is that interest rates are rising at the same time that valuations are rising. And that raises an important question. Well, on the face of it, we've had a reversal of what we've had over the last 40 years. So now valuations are increasing, but with interest rates and the discount rate at which they're being assessed is also rising. It means that those valuations are in fact even higher than the headline figure. So that obviously then means that there is a very significant dependence on corporate profits continuing to perform.